In this course, we've talked at length about fiscal policy, whereby the federal government uses deficit spending in order to boost aggregate demand and stabilize the economy in a recession. But we've ignored somewhat the budgeting process by which fiscal policy is determined. Let's take a look now. Here are some charts for 2021 showing what areas the government spends the most money in and where they collect the most tax revenue from. On the spending side, the largest category was income security, which is a bit of an anomaly. This reflects the additional spending the government did in 2021 in response to the COVID-19 pandemic and is not usually part of the government's budget. In recent years, the largest expenditure has been for Social Security. After that is spending on health-related items such as the Affordable Care Act, commonly called Obamacare, and Medicaid, which provides health insurance to the poor. The national defense comes next, and then Medicare, which is health insurance for the elderly. After that is our real point of focus here, which is the interest payments made on the national debt. There are, of course, many other things the government spends money on, from law enforcement to housing to veterans benefits, but each one of those categories is individually small. On the revenue side, the largest source of tax revenue is individual income taxes. These taxes have a progressive structure, meaning that the higher your income is, the higher the percentage of your income you pay in taxes. In 2021, for example, if you made around $50,000 per year, you paid a little under 11.5% of it in taxes. If you made $500,000 per year, you paid nearly 30% of it in individual income taxes. All told, these individual income taxes are about half of the government's revenue. The next biggest category are the payroll taxes, which fund Social Security and Medicare. These taxes are also usually deducted from your paycheck like income taxes are. And the government also collects taxes on the profits earned by corporations, as well as many other minor sources of revenue such as tariffs on imports. As we have learned, the government revenues do not always match government spending. In 2021, the federal government spent $6.82 trillion, but it only collected $4.05 trillion in revenue, meaning that it ran a deficit of $2.77 trillion. So what happens in this case? How does the government get the money to cover their budget deficit? They borrow. In order to borrow money, the government issues Treasury Securities, also called government bonds. There are several different types of Treasury Securities. Treasury bills, also called T-bills for short, are issued for terms less than 1 year. The government essentially auctions these T-bills off to anyone who wants to buy one. Owning a T-bill means that when the term of the security ends or when it matures, the government will pay the bearer a fixed amount of money, say $100. People and organizations bid on these, paying, say, $99 for it, allowing the government to raise money which it will pay back with a little interest later. Treasury Notes, or T-notes, are issued for terms of 2, 3, 5, 7, and 10 years. These have fixed interest rates, and the government makes payments throughout the life of the Treasury note to whoever holds it, kind of like a traditional loan. Treasury Bonds, also called T-bonds or long bonds, are issued for terms of 30 years and work the same way as Treasury notes. There are a few other types of securities with interest rates that adjust for inflation as well, but by auctioning these off, the federal government is able to borrow money to cover its budget deficits. Many people express concerns about the ownership of U.S. debt, by which they mean the ownership of U.S. Treasury securities. Here are the top 10 owners of those securities. Almost half of all securities are owned by U.S. investors. That includes various investment funds, as well as ordinary people who invest their money in Treasury securities. That means the government is borrowing from its own citizens. These bars in light blue show a few other major holders, which include the Federal Reserve, the Social Security Trust Fund, the Department of Defense, a fund used to pay benefits to people with disabilities, and the fund which finances Medicare. These 5 categories are all part of the federal government. For many years, more money was collected by Social Security taxes than was paid out in benefits, leading to a surplus in the Social Security Trust Fund. That fund used that money to purchase Treasury securities. And so essentially, one part of the government borrowed money from another part of the government. These are the sort of oddities that occur in a large country like ours. Then there are also countries like Japan, China, the UK, and Ireland on our chart. These represent individuals, corporations, financial institutions, and governments in those countries who have invested in U.S. Treasury securities. So a fair bit of the money the government has borrowed has come from foreigners. This is not uncommon, and many investment funds put money into bonds issued by governments around the world. In fact, I recently learned I own government bonds from a bunch of different countries through an investment account I save money in. Many people have pointed to this foreign ownership of U.S. Treasury securities as a problem of national security, and it's certainly true that a coordinated effort by foreign nations could cause problems for the U.S. economy. But such actions come with the price tags shown here for those nations. Damaging the U.S. economy this way would mean giving up the investments they made in those securities, which makes it pretty unlikely that such a thing would ever happen. The federal budget deficit has been getting bigger, though. Through most of its history, the U.S. government tried to maintain a balanced budget, believing that doing otherwise would do damage to the economy. But Keynes uncoupled spending with revenue, and World War II removed all doubt that, in fact, the government could run very large deficits without seeing detrimental effects on the economy. Since the 1970s, however, the budget deficit has been trending upwards. And save for a few years of surplus in the late 1990s, there have been consistent deficits for several decades, with large spikes during recessions like the one in 2008 and the COVID-19 pandemic. But looking at it this way is a bit deceiving, because over these 120 years, the economy has grown quite a bit. A $1 trillion deficit isn't what it used to be. Economists prefer to look at what we call the debt to GDP ratio, which divides the total public debt by the GDP for the country. The total public debt, or federal debt, reflects the total amount owed by the federal government. So if the deficit is what we put on the credit card this month, the federal debt is the total amount we need to pay off from all past months plus what we added this month. Our deficits accumulate into the total debt. In 2020, the federal debt totaled $26 trillion, while GDP was $20.9 trillion. If you divide the debt by the GDP, you get the debt to GDP ratio, which was 124.4%. The federal debt was 124.4% of GDP. As you can see in the chart, the debt to GDP ratio for the US has been rising over time and rising rather rapidly in the last decade or so. Many people are alarmed by this rise and have called for more fiscal discipline on the part of the government in order to reduce the debt burden. As I record this sentence, the national debt works out to around $90,000 per person. But we have the tools to assess how much of a problem this really is. It all comes down to the interest rate. We saw that the interest payments on the national debt are about 5% of the government's total budget, which is pretty low. Most families carry a similar debt burden, even when we exclude mortgages. And while budget deficits have been rising, the interest rate the government is paying has steadily been declining. Interest rates for government securities in 2020 were typically below the inflation rate, meaning that the government is paying a negative real interest rate. In that situation, it's actually cheaper to borrow money than raise it via taxes. And so, on the fundamentals of the situation, the national debt isn't a major concern, despite the shrieks of those trying to get your vote. But just because it isn't a problem now doesn't mean it won't be a problem later. So what would make it a problem? We have a template for what a debt problem looks like. After the financial crisis in 2008, the Greek government began to run into trouble. Their public debt ballooned to 127% of their GDP. But more important to the situation was that their government went to great lengths to hide that debt. The discovery of the debt led to a huge spike in the interest rate the Greek government faced when borrowing. Very quickly, a huge share of tax revenue the Greek government collected had to be used to make interest payments on that debt, and the entire Greek economy crumbled in the mess. One important thing to note is that Greece did not have its own currency. In 2000, most of the nations of Europe joined a currency union known as the euro. By having a common currency, the nations of Europe were able to boost trade and economic growth. But it also meant that European governments did not have control over their currency anymore. Instead, that control lies with the European Central Bank. This greatly limited Greece's options in the crisis, and its continued membership in the euro meant that the mistakes of the government fell heavily on the Greek people. So, could something like this happen in the United States? We'll dig into that a little more in the next video.